Brings someone who can help us figure out what we actually do with the money. He's a guy who manages $300 million. He is, of course, Chuck Lieberman, the Chief Investment Officer at Advisors Capital Management, a veteran of Morgan Stanley Lehman, and a former New York Fed economist. You're actually a doctor, Chuck. I should be calling you Dr. Lieberman.
Chuck is fine.
Chuck is fine. All right. Sales, home sales. Everyone's talking about it today because it seems to be the positive headline that set the tone. What's your take on housing sales up 7%?
It's the beginning of a long uptrend. There's a lot to go. Household formation, the underlying trend is about 1.5 million. That's how many housing starts we need in this country per year. So the fact that we've been running 600,000, give or take 50,000, gives you an idea of how much we've underbuilt to make up for the problems of the 2006, 2007 period. We've got a lot of recovery ahead of us in housing.
And when you say a lot of recovery, by that do you mean it's going to take a long time for us to absorb the inventory of homes still on the market or sort of in the shadows?
No. Much of the inventory that you're talking about, the shadow inventory, is largely occupied. So when that housing comes on the market, you dump a unit on the market, but you also dump a household on the market. They'll move into rental units. And as we've seen, the rental market has picked up pretty dramatically. We're seeing increases in rental rates. They've been hitting in the CPI for a better part of a year now. We're seeing rental companies doing very, very well. All the real estate investment trusts that own apartment buildings have consistently been reporting rising occupancy, rising rents. They're investing. They're putting up more property. If you look at the mix of housing starts, it's tilted towards multifamily units, away from single-family units. So I think the housing bust is over.
And by the way, though,
the housing boom is
You just hit a key point that they're building the multifamily units. Is that because people can't afford houses, so they're moving in or buying apartments now?
Well, I think some people who are being displaced from owner-occupied housing maybe never should have been in that housing to begin with. Those people can't buy a house. They are forced to go into rental units. So it's the rental part of the market that's recovering first. The single-family home market will follow.
So essentially, basically, people who are bad at paying their mortgages may be good at paying their rent, if we have to just boil it down.
That's right. It's a lot more manageable. Although these days, with interest rates where they are, for somebody who can afford to buy a house, in many cases, the cost of home ownership is actually lower than the cost of rental.
Shopping list. You actually have a way of playing this rebound in housing, you say. It may take a while, but you have construction is part of it. Autos, interestingly, another part of it. But within housing, you say there's some safe ways to do it, some aggressive ways to do it. Talk us through what you mean by that.
Well, the safer ways are some of the broader line companies like a Home Depot or a Lowe's. They obviously cater to the entire construction market, repairs, alterations, as well as new construction. That's a broad way to play it. They're cheap stocks. They'll continue to grow.
Home Depot up 23% on the year.
That's right, and a lot more potential.
About timing, because as you alluded to, really timing is everything.
That's
we
right.
are at least 3 years away, right, from a serious housing recovery. So is it too early to get into these names? No, you disagree with the 3 years.
I think we're at the beginning of the recovery now.
Okay.
I think when we look back at what has happened already, we will probably conclude that the turn actually occurred in 2011, probably a couple of months ago. Are you aware, for example, that in the last 4 quarters in GDP, 3 out of 4 quarters, housing was a contributor to GDP growth? Most people aren't aware of that. Housing activity has bottomed out. If you look at construction activity, it's up off the lows. Not a lot, but it's up off the lows. So if you're looking for where the turn is, I think we're past the turn.
It already happened, so it's not too early to get into some of these stocks.
And the expectation for the reasons that you gave, Deirdre, are so negative. If you ask a lot of people, when is the recovery in housing coming, a lot of people will tell you it's not going to be for 2, 3, 5 years. Some people who are detached from reality will say it's not in our lifetime. But the fact of the matter is it's already underway, and I think there's so much to run because the current rate of construction is so far below the underlying trend in household formation.
You mentioned Home Depot, also Owens Corning. Do you have a top pick within housing?
Boy. But one company that I like a lot is a company called Trex. It's a smaller company. They make the composite wood decking material. The stock has been fairly volatile over the course of 2011, reflecting the movements in the market, but we think it's very cheap.
Put on your big picture hat for a moment. We've got about a minute left. The trade for 2012. In other words, in 2007, the trade was commodities. In 1999, the trade was tech. Is there a trade for 2012?
Well, it's not easy. But I think that if the economy does well, and the expectations are very weak for the economy, and Europe doesn't blow up, then I think the trade will be anything that's cyclically sensitive. And so that feeds in perfectly to our auto story, to consumer discretionary, to materials, to industrials. I think that part of the market should do rather well, as long as the economy continues to recover.
Well, you mentioned the economy. We continue to talk about Europe. We continue to talk about the risks that the U.S. economy faces because of the sovereign debt crisis in Europe. What effect, if any, do you think that's going to have on the U.S. markets and specifically banks in the new year?
Well, the problem, of course, is the risk of contagion if the European markets, credit markets, melt down. And that occurs only if there's a collapse of something like Greece or it spreads to Italy. So I think.
And what are the chances of that?
I think that's a low-risk event, because if there's anything that the ECB and the European governments are going to want to prevent, that's it. When you read today's Wall Street Journal and they discuss what happened in 2011 as the Europeans tried to get together to resolve Greece, I mean, the only thing that focused their mind was the threat of being shot imminently if they allowed Greece to default.
Well, and they learned, presumably, from our credit crisis as well.
They did, but
we hope so.
They did, but they also allowed the thing to get awfully close to the edge of the cliff by being unable to come to agreement on how to resolve Greece earlier rather than later. They waited until they had to. And I think there's always that risk again for 2012. But I think they are moving forward in the right direction. This 36-month financing that they've made available through the ECB to the banks, I don't think people realize the significance of it. The best way for the banks to use that cash is to buy back their own debt. That gives them an instant capital gain.
Not go out and buy sovereign bonds.
Not go out and buy sovereign bonds. That leverages them up more, and it makes them even more vulnerable to the very criticisms that they've been exposed to for 2011. After all, if they buy more sovereign debt, they become more leveraged, more exposure to sovereign debt, much more exposed. If instead they buy back their own bonds, they earn the same positive carry, but because their bonds trade at a significant discount, they get an immediate capital gain that lands on their bottom line.
All right, if they go out and spend money buying their own bonds back, can they use those assets to count as capital that they have to hold under the new Basel III rules?
The profit becomes capital. Right? If they issued a bond at 100.
But the bond itself doesn't. In other words, you can't post the bond on your balance sheet and say, this is part of my capital.
They're buying back their own debt. So it would be Deutsche Bank buying back Deutsche Bank bonds.
So the cash line on your balance sheet goes up.
So the bond line on your balance sheet goes down.
Your cash goes up.
Your cash goes down. You got more cash from the ECB, but you use the cash to buy back your own bonds. So your debt goes down. Your long-term debt goes down. Your short-term debt, borrowings from the ECB, goes up, and your capital goes up to the extent of the difference in price. And that difference is the entire decline in the value of your bonds. So the owners of UniCredit bonds who bought them at par, they're happy. They were happy when they bought them. They're very unhappy now because they're trading at, let's say, 75 cents on the dollar. But they want to get out of them because they're worried about it. They can sell them back to UniCredit at 75 cents. UniCredit books an immediate 25-cent profit per dollar, which lands on the bottom line, adds to capital. It reduces their leverage ratio, improves their profitability. It's a win-win-win across the board.
So the trade for investors is buy the bank bonds before the banks buy the bank bonds.
That's right. I think that's a much better trade.
And which banks specifically?
The deeper the trouble of the bank, the more the bank bonds have fallen in value, the bigger the capital gain the bank can make by buying back its own bonds.
That is spoken like a true hedge fund manager, going out and finding opportunity.
Of which I'm not.
Which you're not, ironically, because you are a long-only manager.
Right. That's right.
But not afraid of getting out on the risk curve.
And not afraid of understanding or trying to understand what it is that these institutions should do to take advantage of the opportunity that they're being given.
All right, Chuck Lieberman, CIO of Advisors Capital Management. Thanks for coming on the show.
Thanks, Adam.
Always good to get your insight.